Are you tired of feeling like your money is just slipping through your fingers? Do you dream of a life where financial stress is a distant memory, replaced by security, choice, and the freedom to pursue what truly matters? If you've ever wished there was a simpler, smarter way to build wealth, rather than grinding away, then this video is for you. In the next few minutes, we're going to unlock the fundamental principles that allow your money to work harder for you, not the other way around. This isn't about get-rich-quick schemes. It's about practical, proven strategies that can transform your financial future, regardless of where you're starting. Stick with us because understanding these concepts isn't just about accumulating wealth. It's about buying back your time, securing your future, and giving yourself and your loved ones the gift of true financial freedom. The journey to financial freedom often feels daunting, a winding road filled with complex terminology and overwhelming choices. But what if we told you it doesn't have to be? The core idea behind investing smarter, not harder, is leveraging efficiency and automation. Think about the most successful people you know. They don't just work endlessly. They build systems. They make strategic decisions that yield exponential returns over time. We're going to dive into how you can adopt that same mindset for your personal finances. This isn't about cutting every latte. It's about understanding the power of compound interest, making informed decisions, and setting up an investment infrastructure that runs largely on its own. Imagine waking up knowing your money is growing, even while you sleep, freeing you from the constant worry about your next paycheck. That's the promise of smart investing. Before we even touch on specific investments, the absolute bedrock of smart financial decisions is a solid budget and emergency fund. It might not sound glamorous, but skipping this step is like building a house on sand. You need a clear picture of your income and expenses. Utilize a digital budgeting app, or even a simple spreadsheet to track every dollar. This transparency is your first step towards control. Once you understand where your money is going, you can identify areas to save. Those savings then fuel your emergency fund, a crucial buffer of 3 to 6 months' living expenses held in an easily accessible, high-yield savings account. This fund protects you from life's curveballs, a sudden car repair, a medical emergency, or unexpected job loss, without derailing your long-term investment plans. Without this safety net, any market downturn or personal crisis can force you to liquidate investments at the worst possible time, undermining all your hard work. Building this foundation might feel slow, but it's the responsible, smart way to prepare for the inevitable ups and downs of life and the markets. With your financial foundation secure, it's time to talk about the real game changer, compound interest. Often called the eighth wonder of the world, compound interest is simply the interest you earn on both your initial principal and the accumulated interest from previous periods. It's a snowball effect. Imagine a small snowball rolling down a hill, picking up more snow as it goes, becoming larger and faster. Your money does the same. Starting early is paramount here. Even small, consistent contributions over a long period can outperform much larger, later contributions due to the magic of compounding. For example, a young person investing just $200 a month consistently for 40 years could accumulate well over $1 million, assuming an average market return, without ever making a single major lump sum investment. The key is consistency and time. Many modern investment platforms provide visual calculators that allow you to see this principle in action, showing how your money can grow exponentially over decades. This visual demonstration can be incredibly motivating, turning abstract numbers into tangible future wealth. Now, let's talk about where to actually put your money. For most people, especially those starting out, simplicity and broad market exposure are your best friends. This is where index funds and exchange-traded funds, ETFs, shine. Instead of trying to pick individual winning stocks, a notoriously difficult and time-consuming endeavor even for seasoned professionals, an index fund or ETF allows you to invest in hundreds or even thousands of companies simultaneously with a single purchase. Think of buying an S&P 500 index fund. You're essentially buying a tiny piece of the 500 largest U.S. companies. This strategy offers immediate diversification, spreading your risk across many different industries and companies. If one company performs poorly, it's unlikely to significantly impact your overall portfolio because the other hundreds of companies are still there. This contrasts sharply with individual stock picking, where a single bad investment can wipe out a significant portion of your capital. Many online brokerages make it incredibly easy to buy these funds, with just a few clicks. Diversification isn't just about spreading your money across many companies. It's also about spreading it across different asset classes. While stocks are essential for growth, consider adding bonds to your portfolio, especially as you get closer to retirement. Bonds generally offer more stability and less volatility than stocks, acting as a ballast during market downturns. They provide a predictable income stream and can help preserve capital. Real estate through real estate investment trusts, REITs, is another way to diversify without the complexities of owning physical property. REITs allow you to invest in a portfolio of income-generating real estate, like apartment buildings or shopping centers, through publicly traded stocks. For some, even alternative investments like certain commodities or cryptocurrencies, in very small speculative allocations, might be considered once a robust core portfolio is established. However, for most, a balanced mix of global stocks and bonds through low-cost index funds is the optimal, smart strategy. The goal is to avoid putting all your eggs in one basket, reducing your overall risk while still pursuing healthy returns. The true brilliance of investing smarter, not harder, lies in automation. Set it and forget it. Once you've established your budget, built your emergency fund, and decided on your investment strategy, automate your contributions. Most investment platforms allow you to set up recurring transfers from your bank account directly into your investment accounts. Whether it's $50 a week or $500 a month, make it automatic. This removes the need for conscious decision-making each time, eliminates the temptation to spend the money elsewhere, and ensures consistency, a key ingredient for successful long-term investing. Your future self will thank you for this discipline. Many employers also offer 401k or similar retirement plans with automated deductions directly from your paycheck, often including an employer match. Always contribute enough to get the full employer match. It's essentially free money, an immediate 100% return on your investment, and a cornerstone of smart investing. Another crucial aspect of smart investing is minimizing fees. Every dollar paid in fees is a dollar not working for you. Be wary of high-cost mutual funds, excessive trading fees, or financial advisors who charge a large percentage of your assets under management without clear value. Look for low-cost index funds and ETFs from reputable providers. Many modern robo-advisors offer automated portfolio management at a fraction of the cost of traditional human advisors, making sophisticated investment strategies accessible to everyone. These digital platforms leverage algorithms to build and rebalance diversified portfolios tailored to your risk tolerance, keeping expenses minimal. A difference of just 0.5% in annual fees can translate into tens or even hundreds of thousands of dollars less in your pocket over a few decades due to the power of compounding working against you. Scrutinize those expense ratios. They are often hidden wealth destroyers. Finally, managing your emotions is perhaps the hardest, yet most critical, part of investing smarter. The market will go up and it will go down. There will be periods of euphoria and periods of panic. The smart investor understands that volatility is normal and embraces a long-term perspective. Avoid checking your portfolio daily. Resist the urge to sell when the market crashes, often the best time to buy more, or to chase the latest hot stock when everyone else is talking about it. This emotional discipline is often what separates successful investors from those who consistently underperform. Think of successful investors as marathon runners, not sprinters. They focus on the finish line, pacing themselves, and not getting distracted by short-term fluctuations. They understand that time in the market beats timing the market. When you automate your contributions, you naturally engage in dollar-cost averaging, buying more shares when prices are low and fewer when prices are high, which smooths out your returns over time and removes the emotion from the equation. By mastering your money through budgeting, understanding the immense power of compound interest, diversifying your investments with low-cost funds, automating your contributions, minimizing fees, and maintaining emotional discipline, you truly will invest smarter, not harder. This isn't just about accumulating a large number in a brokerage account. It's about the life that money enables. It's about having the freedom to take that dream vacation, to spend more time with family, to pursue a passion project, or even to retire years earlier than you ever thought possible. It's about replacing anxiety with confidence and scarcity with abundance. The path to financial freedom is within your reach, and it starts with making smarter, more intentional choices today. Start small, stay consistent, and watch your financial future transform. What step will you take today to invest smarter? We'd love to hear your thoughts in the comments below.